Hey guys, so in the video today I want to go through the very basics of accounts. Whatever company you have in the UK, whether it's a little shop, a property investment business or something else, you usually create a limited company. I can talk through that in a different video, but create a limited company, so your business, and then that business will need to have accounts. A lot of people just hire an accountant, pay them every month, it's all done, it can be sorted. But really, as a business owner, every single one of you should understand the basics of accounts. It's extremely crucial. By understanding it, you'll be able to avoid so many decisions. You'll be able to avoid paying penalties. You'll be able to avoid trying to fix something later on because you've not entered it correctly in the first place. So in this video I'm going to explain what the different types of accounts are in the UK, what the main ones are, and then just give you the very basics of each one. In future videos I will expand and go more into where things can be put in for different items, how things can be capitalized, all of that sort of stuff. But here I just want to give you the basics. It's really initial stuff, but it's crucial. It's crucial for every business and it helped me massively. So let's get into it. When you have a company, you are going to be the director of that company. So the company exists separately from yourself. However, you are the shareholder in the company, maybe with others, and you're the director of the company, so you make the key decisions in that company. So that's a structure that's quite popular and is set up in many UK. It's called a limited company. So the person can set that up. I mean, there's plenty of people that will rip you off, but you can do it yourself very cheap. Once you've set it up, you are trading, you are doing your business, you're getting money in, you're spending money, and you need to show that. You need to give an account of what's been happening with your business or every year. So the first thing that you need to show is profit and loss account. It's very self-explanatory. You will have a look at how much money did you get in, how much money have you spent, what kind of profit have you made as a result, and then that will help you calculate how much tax you need to pay to the government. So let's have a look at it here. This is the profit and loss account. I've just written it here. I was going to write it as I talk, but I thought maybe I'm going to forget something and make a mistake, so I've got it pretty much ready for you here. You start off with your income. For example, if your business is a property business, your income will be your rent that comes in. So say you have a property that brings you £1,000 a month. So over the 12-month period, you get £12,000. That's your income. You have a think about, over the past year, have I received any other income? Probably not. So you put 0 for that one. So overall, over the past year, you've been getting your rent from your business, which is £12,000. So your overall income is £12,000. You then think, okay, so I've had this flat, I've been renting it. What sort of expenses did I incur as a result of having this flat? For example, you might have had to do a gas check on it. So let's just say here that was £100. Once there was a leak and you had to get the plumber out, that was another £200. Another time you had to buy some materials that you then used to redo part of the flooring that was broken, that was another £400. And you just have a think about what else have I spent money on. Maybe it was unoccupied. The property was unoccupied for a month, and during that month there was £300 of bills that I had to pay. So you add that in as well as an expense. So that's £1,000. This should say depreciation. And this is where you have equipment for your business. For example, you have your work phone. You have your phone that you use for your business. So that's where your customers are calling you. That's where you're calling your customers from. That's where you're doing your calculations. That phone you have bought for, I don't know, say £1,000. Let's just put that here, £1,000. You bought that last year. If you were to sell that phone now, would it still be 1,000? Probably not. It's probably £500 now. So that means it depreciated by £500, and that's a depreciation expense that you can put through. Transport mileage. With that, you need to look at the guides for HMRC in terms of per mile, how much you can claim, but you need to have a think reasonably, how much have I traveled? So for me, for properties, I might have gone to Edinburgh 5 times to look at properties. I might have gone to a property event in Dundee and that was something that I went there to meet my future potential customers. I didn't go there for pleasure. I went there for business. So what was the transport over the course of the year? Have a look at the guidance, but I don't know, it could be 200 quid you've spent. And then other, say 0. So now you've got rent of 12 grand coming in, expenses, you had some repairs, maintenance, all of that sort of stuff, depreciation. A big one for any property investors is the interest on the mortgage. So in a company, you can claim that back. Say you're not exactly a rich person who has this flat bought outright, you actually have an interest on the mortgage, and that's costing you, I don't know, £400 a month. So the mortgage payments were actually 4,800. So you've got 12 grand of rent, 4.8 grand went to the mortgage company for the interest on the mortgage that you have. Repairs and maintenance, £1,000 is what you've spent. Depreciation of your assets, business assets, 500 quid. Transport 200. So your total expenses over the course of the year is 6,500. So total income 12,000. Total expenses 6,500. How much profit have you made? You have made 5.5 grand. You take your income, subtract your expenses, you're left with your gross profit. This number is what you need to pay tax on. So this is the amount of money that you have now after you've paid your expenses. Therefore, the government taxes you on that. For smaller companies, that's 19% corporation tax. That's just over £1,000. And you're left with a net profit of £4,455. When you have a company like this, you need to be careful because you can't just then take that £4,400 and go and spend it. You need to either use it within the company to be growing the business, or you need to take it out as a dividend or as a salary. There's tax implications to all of those things. So please read more on that, and I'll do more videos on that in the future. This is just a basics overview of how it works. So let's summarize. Profit and loss account. You have your profit. So your income, your turnover, how much money did you get throughout the year? How much money have you spent? What are you left with? Okay, take that amount, take the tax off that, and that's your net profit. This is the basics for every business and something that every person should know. But I'll do more detailed stuff on that later on. The second thing you need is a balance sheet. That shows you the health of your company. So what sort of assets does your company own? Do you have any properties? Do you have any trucks, cars? Do you have any massive loans that you have to pay out? So within the balance sheet, you look at your assets. So first your fixed assets. For my business, it's a property at £100,000. Computers, £2,000, just a rough figure. Office, some other stuff, etc. are 0. So you have fixed assets at 102,000. Current assets are things like how much money are in your bank, and you have someone that owes you money, so you capture that in here. Total current assets, in this case 5.9 thousand. So for your assets, you sum them all together, and overall your company at this point in time has £107,900 of assets. So next we move on to liabilities. So we've talked about the assets. We know that in here you analyze how much does your company actually own. So fixed assets is things like property, fixtures and fittings, etc. So in this case it's 102,000. Current assets is how much liquid cash do you have available in your bank, how much do people owe you. Altogether is the sum of your assets, or your total assets. Then you need to look at what does your company need to pay out, what liabilities do you have, what does your company owe to other people. This one is usually split into current liabilities and non-current liabilities. I need to still get a full definition of that, but I believe current liabilities are within 1 year and non-current liabilities are longer than 1 year. So the current liabilities could be creditors. You might have to pay somebody in the next few months money that they have borrowed to you, so you need to pay them back. Director loan actually shouldn't be here, it should be a non-current liability, but as a director you can give the company money, so you can give your own money to the company, and then when the company becomes more successful you can take that money back out because you've loaned the money to the company and then you want it back. So you can have a director loan. You can have a mortgage. Obviously, if you've got a property, you need to pay the mortgage. So interest-only mortgage, a repayment mortgage, whatever it might be, but it's a liability, something your company owes. And then there could be other liabilities. So whatever your company needs to pay somebody or someone or some company in the future is a liability. So we've talked about assets. Liabilities, again, you make a sum of them. So in this case, we've got £100,000 of liabilities. And then what is your net position? So you take all the money that your company has, assets and all the good stuff, take away all the liabilities that the company has, and you're either left with net assets. So your company in this case has 7.9k of net assets, or net liabilities. It could be that you owe a property for 50,000 and you have a mortgage for 100,000. It shouldn't be the case, but it could be, in which case the net position is minus. So your company has less assets than liabilities. So balance sheet just shows kind of the health of your company, which is a really important account to actually show. There is also the sort of reserves, retained earnings as well, and that should balance with the net asset and liabilities. And that's really just some of the built up money from previous years, etc. So this is not worth going into too much detail. So hopefully with that in mind, we've went through the profit and loss account right there. As you can see, income, take away your expenditure, you end up with your gross profit, take away the tax net profit. Nice and simple, now you understand what it is. And also balance sheet. You know, you look at your assets that the company has, liability the company has, what's the net position, that's it. So it can be accountants can be very smart with all those accounts. You can start manipulating things, putting one in here, one in there, making extra columns, arguing that something should be somewhere else. It can get very complicated, but the basics is just this. That's all there is to it. I'm going to go into more details in future videos around how to what I've learned about accounts and how certain things should be treated and what the regulations are, etc. But for this video, hopefully you got the basics and hope you enjoyed it. And again, for me, it was good to do this in a simple way myself, and every time I explain it, I understand it better myself, so it's actually helpful for both. But thank you for your time.